The easiest way to become a profitable trader and start making money consistently is to learn how to trade with the trend. And so in this video, I'm going to walk you through absolutely everything there is to know about market structure so that you can read the right trend every single day. Okay, now I'm going to walk you through from complete beginner to the most advanced structure concepts. And I want to just simply start off with basic highs and lows, understanding reversals, and why trend lines always fail. So we're going to start off with the theory, right? Which is us using this line graph. And then I'm going to take this exact concept and go straight over into the charts themselves to show you how to read this in real time. So essentially your trend is everything, right? If you just master the direction of price, you will have a very hard time not being profitable. The issue is that so many traders get caught on the wrong side of the market. They try to long when they should short, and they try to short when they should long. So you want to start off by identifying the external swing points of market structure. These are the areas that price hits and then reverses from. And you can see they are always on the edge of price. Very simply put, you need to identify these levels and then you need to understand their direction. So here we have a low and then we have a high. That is our baseline. Then from there, we come down and we put in this new low. We know it's the low because it's the point that price hits and then immediately starts reversing from. This creates a swing point. Now this swing point here is higher than this swing point here. That is the first indication of bullish price action. Then we have a break of structure and we have a higher high. This high right here is higher than the previous high. This is already your clear indication that we are indeed bullish. Once you have this information dialed in, your only job is to try to find the next higher low and take off your profits at the next higher high. It's literally that simple. And so again, we have lows, higher highs, higher lows, higher highs, higher lows, and higher highs, right? This is what you should truly be relying on to develop your understanding of the trend. Now, the reason that trend lines fail is because they're not based off of the swing points of market structure. They're based off any random line that we draw up that we try to understand market structure with. For example, right, let's say I draw a trend line here. Now you can see that this trend line looks something like this, right? And that's all well and good. I mean, we bounce off it multiple times. But the problem with a trend line is it takes getting in multiple of these lows before you can even develop the trend line itself. And so by the time that you can see this trend line, usually it's too late. That's the thing with trend lines. They always look good in hindsight, right? After they have already played out. But when you're trying to trade them in real time, it's almost impossible. And one of the biggest issues is, let's say, for example, this is our price action, right? So this is our trend line up here. Well, what a lot of times happens is after we've developed some type of trend and we've developed a trend line, we usually get something like this. Price may stay in one area for a while. And then as it starts approaching this trend line here, right, most people are looking at this as their indication to buy. And let's say we have a little bit of a reaction. This is where so many people are looking to buy because this trend line is holding, right? But then what happens? Well, then we break through the trend line. And when we have this trend line break, a lot of traders are being taught that now we should be looking for shorts off this level. The problem is that we're still bullish because this is our low down here and this is our high up here. And so realistically, there is a much higher chance that price is going to go to this high, right? Probability indicates that in a trending market, there is a higher chance that we will continue the trend than we will reverse in the trend, right? It's very simple. And so if you want to trade with probability on your side, meaning you'll be right more times than you're wrong, then you want to make sure that you're using market structure. Here, there are going to be traders that are taught to short the market when actually the market structure is bullish. And so what we want to do is we want to buy, right? So nobody is looking to buy this trend line anymore. In fact, actually they're looking to sell the trend line. And then traders who are trading market structure are actually able to be looking at buying down in this region. And so we are literally just low, high, higher low, higher high, higher low, higher high, higher low, higher high, right? Correction, higher low, higher high. And so that is exactly ultimately why trendline fails. Let's look at this in another light, right? Let's use some bearish price action. So taking the same principles, we have a high, we have the low, we have a lower high. This high is lower than the previous one, an indication of bearish price action. Then we have a bearish break of structure. So we break the current structural low and put in a lower low. At this point, it is very clear that we are bearish. We should only be looking to short the market. So we put in a lower low again, lower low, lower high, lower low. Now the issue comes very similar again, right? In this instance, let's say you take a trend line. And now how do you draw the trend line? Do you draw it like this? Well, that kind of doesn't really make too much sense. So do you draw it like this? So now let's say we have this trend line drawn out like this, right? Now let's say you're a trader who's waiting for another touch of this trend line. And so what happens? Price comes back up and hits this trend line. And so now what trend line traders think is that we are still in a bearish trend because this line is being respected, which in reality couldn't be further from the truth. We've actually just shifted to bullish, right? This is what a reversal is. A reversal is, in its simplest form, when we're getting these lower lows like this, we're bearish, we're getting lower highs. When we get a higher high, meaning we take out the high that put in the most recent low, that is what we call a change of character. A change of character simply just means that we are shifting from being bearish to bullish, or shifting from being bullish to bearish. This for us is a change of character. Now again, something that a lot of traders get wrong is maybe they don't consider this as the level. Maybe they use this one, or this one, or this one, right? This is what you need to understand. The moment that we have broken a low, the high that is responsible for producing that low is no longer anything more than liquidity, right? Now, I know I'm getting a little bit ahead of myself here, but let me say that again. The high that puts in a low is only important until that low has been broken. The moment that this low gets broken, this high is no longer important. Now it's about this high. And so all you need to focus on is the current high and low. Again, this low gets broken. So now this is the low and this is the high. This high is no longer meaningful. All that this means is that it's a future point of liquidity, meaning that at some point in the future, price will revisit that price level, but they don't mean anything. So again, let's say now we've had a bullish reversal, right, according to market structure, which it would be all the time. So now what we would be looking to do is we would be looking to actually buy this level. So when we hit this level right now, right, and price starts coming back down here, I actually want to be looking to buy this market because we've just shifted to bullish. Whereas a lot of people who are relying on trend lines, for example, which are unreliable, well, they think that this is a great opportunity to go short, and they're probably trying to take out the most recent low. And what inevitably will happen is when price hits this level and it starts moving away, you'll have all these traders that will look to sell, 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 sell. And actually the real move was to buy. And that is ultimately why trend lines fail 9 times out of 10. But market structure, something that is consistently repeatable because you're just looking at the highs and the lows, will prevail consistently. And so trend lines don't work. They are unreliable. And market structure does work, and it is completely reliable. Okay, let's now take this information into live market, right? Here we are, euro dollar. And we're just going to start with taking this high. So this is a high. Now, the reason this is a high is because price reverses from this level. This is a low because price reverses from it. This is a higher high, right? Meaning that this high here is higher than this high here. So we have high, low, higher high. So we are what? Bullish, of course. Then we come down into here. This becomes our low. This becomes our high. Right? So we have higher high, higher low, right? This low here is higher than the previous low. Higher high, break of structure. Now the only thing that matters is this low here and this high here. And then price comes down, puts in a higher low, and then puts in a new higher high, right? And again, price puts in a higher low and then a higher high, right? And so you can see here how we are just developing bullish structure exactly like we just covered with our tool, right? That's all it is. It's just finding these external swing points and making sure that you mark them adequately. So if we remove this now that we've established our trend, what would a trend line look like in this example? This is what I don't ever understand with trend lines because they're just confusing. Let's say you use this as your low, right? And then this is your first low, this is your second low, and then what? You just draw it straight like this. Okay, cool. Well, we have a trend line. Now, by the time that you see it, you can only see it after the second touch. So we hit this level, and what happens? Well, we break through that trend line. So now what? Now this would tell you that once you break it and you retest it, now you should what? Start selling. Well, that doesn't really make any sense because we are bullish. Why would we be looking to sell the market? That would be getting caught on the wrong side. Again, let's look at another example, right? What if we use these trend lines. Like so, for example, right? We start getting this great trend line. And again, this is our swing low. This is our swing high. So we want to just be looking to buy the market. Okay, great. Price comes down into here and you have a bounce off your trend line. Cool. Let's say you start getting into trades. Where do you put your stop loss? Once price starts bouncing, you enter the market in here. And where do you put your stop losses? Probably below the trend line low, right? And you're just trying to target this high in here. Looks like a great trade until price inevitably just comes back through, takes out the stop losses that are in this level, but also then gives a trend line break. And so now what? Well, now they're probably looking to sell the market. So not only have they lost their first long position, now they're actually trying to sell. And of course, price goes against them one more time because they are using trend lines and they are not using the repeatable mechanical model of just simple highs, simple lows, simple highs, simple lows, simple highs, simple lows, right? So in this scenario, let's say you can't see anything here. We have a low, a break of structure, and we have a high. The only objective is simply to try to capture this low and buy this low and take out this high. That is all you need to do when you are a trader who follows market structure. It is literally the easiest form of trading. And so again, high, low, higher high, higher low, higher high. So we're bullish, right? We would be looking to buy the market in here. And then what happens? Eventually, at some time, a trend will become exhausted. Simply put, the market can't just go up in a straight line forever. A market oftentimes goes up and then down and then up and then down. It's very simple. Just supply and demand. At some point in time, you're going to get a shift. When you get that shift, everything changes. Your bias completely switches. You're no longer looking to go long. Now you're looking to go short. So what happens? We have our higher high here. We break this low. We put a low in here. So now we are this high to this low. We come up, high, lower low. Now we are simply looking at bearish price action. Now we're trying to sell the market. So we have our high in here and our low down here. And then what happens? Then we have our high in here, and then we have our low down here, right? And then we have our high here, low here, high here, low here, high here, and low here, right? So if you were to read market structure in this price action, we would have 1, 2, 3, 4 times that we were correct. And then we tried to long in here and we were incorrect. So 4 times we are correct, 1 time we are incorrect. And then bearish, we have, 1, 2, 3, 4, 5. 5 times that we are correct and no times that we are incorrect. And so out of 10 times the market has showed us its highs and lows, its structure, only 1 time out of those 10 times has failed. That is how reliable market structure is when you truly understand how to map it. Now, let me ask you, what do you think the focus is at this point? Now, the only thing that matters, this is why market structure is also just amazing, because you forget about all of the other BS, right? All of the other noise. The only thing that matters on this entire chart is what's happening between this high and this low. That's it. That's how simple trading can be. And so what do you think I'm looking at next? We have a high, we have a low, and I am expecting that price will probably come up and then it will probably come down. And all I need to do is try to sell in here. That's literally it. And so how does price play out? Price starts reversing and then price starts heading its way back down. At this point, what I'm looking to do is try to sell in here and get out the market here. And now what do you think I'm expecting price to do, right? All that matters is this high and this low. All I'm expecting is price to come in here and go back down here. And what happens? Price comes up. Okay. And price goes down, right? And so we go here to here. And so that's now 12 times that we've followed highs and lows. 11 times it has been accurate and 1 time it has been inaccurate. That is because price will go from bullish. At some point when you've had a lot of bullish price legs, you'll go to bearish. And then you'll have a lot of bearish price legs. And then guess what? you'll go to bullish again. And we just want to capture these moments. And then when it shifts, we want to capture these moments, right? These highs. Like, it's honestly the easiest way to try to read a market. It's just simple. Now, just before we move on, I need to stop you for 1 second and tell you something that I wish somebody had told me much sooner. You see, concepts will only take you so far. There are many traders out there who know all the concepts in the world and still struggle to make any money from trading. There is something more important. There is edge, there is systems, and there is one's trading psychology. And so after you finish this video, because again, concepts are extremely important. After you've finished this video, I've left another video for you down below this one. You can click the link in the description. It's gonna take you to another video just like this one, 45-minute free masterclass, giving you everything that you need to become a profitable trader, not just the concepts themselves. I hope you really do enjoy it. Okay, now I need to talk to you about something called impulse versus corrections, and also why so many people get this wrong. Many people get lost and trapped in this process, but I'll explain it to you like you're a 5-year-old because it is literally that easy to understand. At any point in the time, we have impulses and we have corrections. We have impulses and we have corrections. We have impulses and we have corrections, right? And so let's say we've developed a trend. Let's say we are bullish, which we are, right? Break of structure. We want to be trading the impulses and avoiding the corrections. What many traders get lost in for some reason is they try to be impatient and trade these corrections, right? Because price is coming down in the moment right now. They think that it's a good time to be selling the market. But the reality is it's all about patience. You mark out your low, you mark out your high, and you are only trying to buy. And you want to buy these aggressive moves. Now you have a high and a low. Price is going to come back until it finds this low, and then it's going to continue going higher. Many traders are trying to trade these correction points, and they're just going to get obliterated because the structure is actually very simple. It is just low, high, higher low, higher high, higher low, higher high, higher low. And these internal pieces, so anything between point A and point B, point A and point B, is a correction. This is just a correction of the market. Then once you find the low, you have an impulse. That impulse breaks structure. And then you have between point A and point B, you have a correction. If price is going down in this region, you just ignore it until it starts coming up, and then you can trade it. And then we have an impulse. Point A, point B, correction. Point A, point B, impulse. We want to trade impulses, avoid corrections, and many people get lost and trapped trying to read corrections. So what does that look like in the price action that we just went through? So we go back to the price action that we just covered. What we'll see is that we have a high and a low, right? And then we have an impulse. So we actually break structure. We have a swing low down here. We have a swing high up here. This is an impulse. And then what happens is a correction. So price starts coming down, but it comes down in usually a very choppy manner. So it's coming up, down, like this. And many people read this wrong, right? They try to short the market in here. And then they get taken out. Again, this is all just corrections, right? Then the price comes lower. And eventually, when the time is right, you have an impulse. So the market is going from impulse to correction to impulse. And then what do you think happens after that point? Now we have lows down here. We have highs up here. And now we're going to start getting a correction. Right? This in here, this is a correction. This is not tradable price action. You should not be trying to sell the market in here. You're simply just waiting for the opportunity to buy. Right? This is all just a correction. Look how faster we go up versus how slow we come down. Impulse versus correction. And then when the time is right, the impulse will come. And the impulse is usually a lot more aggressive. And it can also come in phases. Right? How does this phase work? Impulse, impulse, impulse. The real move. Slow correction, impulse, slow down, impulse, right? So we want to be trading these impulsive moves in the direction that we're heading, which in this scenario is bullish. And so again, it's impulse, correction, impulse. What do you think is going to happen here? Right? Now this is a correction, right? Price is coming back down in this flavored section. And then impulse. After this level, you start to get some type of correction, right? And so the market is always going from correction to impulse, 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 right? And all you need to do is identify which is the direction of the trend, because the direction of the trend is where you get the impulsive moves, and you want to capture the impulsive moves. Like, you don't want to be the trader who is trying to sell all these little levels in here and get involved in all this like rough, riggedy price action. You want to be the trader who's buying these clean impulsive moves. And notice as well that the impulsive moves are usually coming in the boxes that are in green or in orange. Those are my key trading windows. Okay, now I want to talk to you about one of the most important concepts if you want to be able to trade with market structure for the best results. And that is ultimately trading market structure with supply and demand. And so the easiest way to understand this is we've already understood market structure, right? It's simply just these swing points of price. It's that simple. Now, these areas of supply and demand, essentially, as simply as I can put it, you want to look at the areas where price just kind of sits before the impulsive moves. So we just spoke about, impulse, correction, impulse, correction, impulse. What we want to look at is these areas just before we get the impulsive moves, right? Because these are going to be our supply and demand areas. In bullish examples where price is trading higher, these moves before we get these aggressive impulses, that is going to be our demand. And so it's as simple as this. You find an area of price that sits in a range-like area before you get a heavy impulse. You simply mark out that level. That is an area of demand. So many times price will come back to this level, and that will be the level that you can trade out of. And then again, you want to find these areas of ranges before you get these impulsive moves, and then you want to mark them out because this is where price will come back towards. Again, price comes in, we trade out, we have a little bit of a range, we have another impulsive leg that breaks structure, price comes back into this impulsive layer, and we go again. And so we need to identify these key demand areas in here that create impulsive structural moves, because those are the key levels that price is going to come back to, and so we can trade from them. And it's just the same in reverse, right? If we're looking at a bearish market, you want to identify these kind of rangy moves before these big impulsive levels, and then just mark them out and watch how price comes back to them to respect them. Again, you want to find these rangy moves before the impulsive moves, mark them out, and just watch how continuously price comes back to respect them. Rangy moves before aggressive impulses, and watch how price comes back to respect them. It is like magic. Let's have a look at how this looks like in real time. So if we come back to where we were and we look at this, we can see that we have impulse, price starts coming back. Then we have another impulse. Now notice that before we have this aggressive impulse, we just have this kind of range bound price where price is not really making any movement before it does make a movement. Simply put, just highlight this area, right, this range bound area, and just watch how price comes back to it. Notice how price is like a magnet to this level, how price comes in and then we move out of here and we come back in again. Now here is an internal impulsive move. So we're having an impulsive move in here. And then notice that just before we have this impulsive move, price is sitting here for a series of time without doing anything. This is also another form of demand. right? Price comes back in. And then notice that we have kind of this another impulsive move in here, right? So we're pushing up, but before that, we're just kind of sitting in this level. Again, this entire area pretty much acts like an area of demand, right? It's range bound price before aggressive impulse, right? If we look at the impulse comes, we have impulse back into this level, then we sit here and then we impulse. This level in here acts as an area of demand, right? It's really simple. Now, does it come back to those levels every single time? No, of course not. But you would be literally shocked at how often it does happen, right? It happens all too often, actually. Even still, even right now, you can see, right? We have in this New York session, a very big impulsive move. But just before that impulse, we have this little area of rangy price before the impulse. That in of itself is an area of demand, right? And notice that when price comes back to it, it's this level that price lifts off from. Granted, it does go back down, continue, which is fine. Again, here, what do we have, right? We're having this large impulsive move, but just before we get this impulsive move, look at how price is just sitting at this level. And so that in of itself is like an area of demand, right? This entire region. Again, all we're focusing on is just structure and supply and demand combined. This low, this high, right? These are our ranges, impulses. Honestly, you could even, if you wanted to get technical, you could even look at this entire leg from here. From the moment that price hits this level, it's literally continuously range, expansion. Range back into this level, expansion. Expansion, right? It's just pairing supply and demand with market structure. And then again, we even get it again. We get expansion. Then we get range, expansion. And so this area, once again, is like an area of demand that price is usually gravitating back towards. Now, again, is it every single time? No. But you can see that if you just pair market structure with these range, expansion, out of here, range, expansion, back in, range, expansion, back in, range, expansion, right? Pairing supply and demand with these market structure moves gives you extra clarity on now where we can look at getting trades from. Instead of just understanding market structure, it's like, okay, sure, I understand market structure, but where do I take trades from? And in this instance, for example, you have your range expansion, right? You can literally just take trades off the back of this and you can just target that high. And all you're doing is just trading market structure with supply and demand, which is just range expansion, right? Because all you're doing is just trading the trend. Like the trend is doing all the work for you. This is why I'm telling you that market structure is the best form to trade. The trend will do all the heavy lifting for you. All you have to do is just get in. It's literally like getting a piggyback from a whale. Have you seen in those, like in the ocean, where a lot of the times you'll see one shark that's swimming in a certain direction, and then you'll see all of these fish around the shark, right? Because they are just simply using its dynamic and moving with the whale. It makes their travel a lot easier. It makes them safer because you just know that this is the direction of the flow. All you have to do is jump on the back and ride the wave, right? It's literally that simple. There's nothing difficult to it. You just have to ride the wave over and over again every chance you get, because this is extremely accurate. Okay, now I want to show you something that is just on a whole other level. Right, you've seen those trades that we just took, and you've seen they were good, not bad, but not the greatest of risk to reward, right? If we take, for example, this one, where we had our break in here, we had our pullback, we had our range, and we had our expansion. So if we took this trade here, right, just using this range and targeting just this high, in this scenario, 1.47 risk to reward. Not great. What's something that we could do to make this a whole lot better? It's something that I called confirmation, right? Lower time frame confirmation. So here's what you do. Instead of taking your trade from this area of demand. We're actually just going to use it as an area of interest. So we can see here we have our low and our high. Now remember what I told you at the beginning. Nothing matters other than what's inside of this box. We can even draw a box across it like this. And we'll change its color. Now, it's very faint, but it's very simple. If it isn't inside this box, it is irrelevant. Very easy for many people to get caught in the idea of like all these different time frames and all these different structure points and everything. It's very easy to get lost and confused. But if you just find a 15-minute high and a 15-minute low, or a 15-minute low and a 15-minute high, and you consume yourself with what's in the box, and you avoid everything else, the market becomes such a more peaceful and quieter place. And then all you do is you find an area of demand, which is a range before the expansion. And then you mark up that range before the expansion, and that is your area of demand. When we hit this level in here, right, this area of demand, go from the 15-minute time frame down to the 1-minute time frame. And here's what you'll see. What you'll see is that we have this bearish price action, right? We have high, low, high, low. Price comes up, puts in a low, low, high, low. So the 1-minute time frame is bearish when we get inside of this box. Remember, we're 15-minute bullish, we're inside of a point of interest. Very interesting, very simple. Now what we do is we wait for the 1-minute time frame to go from bearish to bullish, which is just simply breaking this high. We wait now for this high to get broken from this yellow box. Right? Once we've broken this high, what do you see here? Range, expansion. You do the same thing again on a lower time frame. You can mark out this entire range. This is your what? This is your demand on the lower time frame. And what do? Now that's our entry. And where's our exit? Just this high up in here, right? Same concept, but instead of us trying to trade this large thing here, we are basically just waiting for more confirmation, and we're just zooming in. Instead of using this large area, we're finding the exact moment, like a sniper, the exact moment that things start to shift and that price starts heading toward this high in here. And so instead of this being a 1.49 risk reward, it's a 5.7. Meaning in this scenario, if I take this trade here, and let's say I risk $1,000, I will stand to return 1,400 and what was it? 1.49, $1,490. But if I risk $1,000 on this trade here and it hits, I will stand to make $5,700. So same concept, right? Same market structure, same understanding supply and demand with it. But instead, we're just adding one more thing, which is a lower time frame confirmation. And we are going from making $1,490 to making $5,700 on the exact same trade idea just by having lower time frame confirmation. And having something like that is what makes all the difference in your trading. And then you just wait. If it tags you, great. If it doesn't, cool, fine. But now notice on this 1-minute time frame, the structure is this high and this low. And we have this here, which is range, impulse. And we're just coming back to this range. And it's shocking how accurate it stays. All the way up to your take profit. Now, if you thought this video was good, I've got an even better video for you if you want to become profitable this year. I'm going to leave the link to that video down in the description. It's a gem.